Hello and welcome everyone to Almus Market Mornings, your daily dose of global financial updates. Now, the biggest update in the currency markets has been euro hitting parity in yesterday's trading session. This was anticipated by the markets and was backed by a strong rally in the dollar index. Today is the day, of course, when the US CPI will be released and looked at by everyone. JK, good morning. Can a stronger than anticipated inflation number finally break the parity for euro? And how are you seeing the scenarios being played out?
Hey, good morning. Uh, yes, CPI can be one trigger that we see as a factor to break the parity. But if it doesn't, I think there are enough challenges for the Eurozone that tryst with parity is only going to be met yeah, sooner or later. And that's anyway not something that people are looking forward to with enthusiasm, because more of dollar strength, it's going to be more pain for particularly emerging market currencies that particularly those with weaker fundamentals, and also who are also having uh, payment dollar shortages, etc. In fact, IMF has warned about an imminent debt crisis, and in their recent report, they said the nations that don't earn enough US currency but have to service debt in the greenback or finding it twice as hard to keep up. And adding that about 30% of the developing and EM nations are either in or near debt distress. So as we see more dollar strength, this is going to intensify. We have already seen some of the weaker countries like Sri Lanka and Pakistan in our own neighborhood suffering. And if dollar strengthens more nations will be in the list. On the coming back to the markets yesterday, as I was saying, we have either passed on the bear market rally or ended, but now looking at the charts again, I feel the latter. Fears of recession really give the equity players once again, and saw the markets slipping, looking at China and looking at Europe. One of US bond markets most widely watched indicators of potential recession risk has reached levels last seen in 2007. That is the yield on 10-year benchmark treasury rate versus the 2-year rate, eclipsing the 9.5 basis points reached in April. And now this happens amid fears that aggressive rate hikes by the Fed to fight inflation will push economy into severe slowdown. Fed's Barkin, who is of course not a voting member, added to the poor sentiment, saying he is already seeing signs of softening, and he is not sure whether it is going to be 50 or 75 BP hike. And one of the few Fed members to say that. And the recession fears were no more starkly evident than in the oil price, which leaked below 100. Reflecting recession fears, they went down. In fact, Brent has fallen to 99.21 and WTA to 95.71. Also, a factor is China growing COVID-19 case numbers noted as possible causes. Recession factor is so strong in the oil prices that despite OPEC report showing oil demand to outgrow supplies by 1 million barrels per day, and OPEC production data showing quarter's output continues to run below the target in June, the prices have fallen. We did not have any major data from US except the NFB survey of small businesses, which showed a decline to levels seen in 2013. But of course, the focus is on CPI data today, with the market expecting another record number. Even the White House officials are preparing the country for a hot inflation number ahead of the release, so as to mitigate the impact of the number actually when it is released. But they do insist that some key inflation components like gas prices are coming down. So it's really tense wait for the markets till the number is released. Coming to more specifically the US dollar, euro almost hit the parity yesterday, missing it by just 3 pips. But possible option defenses helped it to rebound by about 0.5%. None of the negatives for the Eurozone economy have gone away. Are they getting worse? Possibly, yes. The latest German ZEW survey for both current situation and the expectations for July has hit a new low. But the move higher from parity was a dead cat bounce, and it's just a matter of time. And today's CPI number could be one of them, as I said earlier. Also helping dollar along was when US Treasury Secretary Yellen said that the Yellen really did not agree with the Japanese authorities that there may be need for intervention, and if Japan wants to intervene, probably it will have to go it alone. And we feel that it may happen closer to 140 than at the current levels. This means that more currencies will compete with Japan to depreciate their currency. So that's not good news for the overall global economy, because when dollar is rising, it increases the risk of sentiment actually. Our own rupee made new historical high, but that's kind of become a routine affair now, as you see no change in the demand supply mismatch, and RBI is having to constantly fill the gap, and at the same time letting the currency fall gently along with the peers. That trend should continue. No relief from CPI data yesterday, which once again came above 7% in June. That is 6 months in a row. Not, of course, far from the forecast of 7.03%. Some could see the steady number around 7% as a comfort, but that still is well above the target range of 2 to 6% for RBI, though below the 7.4% projected by them for Q2. So the rate hikes are very much on the cards, even from RBI. The fact that inflation in major countries is still high and Fed is likely to hike by at least another 1.5% this year would make it imminent for RBI to raise rates further. So just like the interest with the parity by euro, interest with 80 by INR is just a matter of time. Thank you.
Okay, thank you, JK. And apart from the recession fears, we also now have the much looked at CPI data, which can cause a lot of volatility in the markets. As we have been saying, always keep managing your risk. That's it from our end today. We'll see you all tomorrow with the latest round of updates. Thank you.